The plan you write before the crash beats the genius idea you invent during it. If you think you are going to intuitively figure out how to navigate a 30% market drop while watching red numbers flash on your screen, you are playing a losing game. The financial media wants you to believe that surviving a stock market crash requires active, tactical forecasting. They parade macro gurus who predict doom, or analysts screaming at you to buy the dip with money you actually need for rent next month. I have run the numbers across decades of market data, and I can tell you definitively that successful wealth preservation has nothing to do with prediction. It has everything to do with passive, systemic execution. When a severe market correction happens, conventional wisdom usually splits into two equally terrible ideas, both of which are guaranteed to destroy your long-term compounding. Today, we are not doing either of those things. We are going to build an exact mechanical crash playbook. Before we tear into the mechanics of that playbook, let us address why so many smart people do incredibly dumb things when the market tanks. If you want the absolute best return on your time, hit subscribe right now, because we focus entirely on the brutal math of building wealth, not the hype. When a crash hits, the standard advice bifurcates. The first piece of conventional wisdom is to stop the bleeding. This is the advice telling you to rotate your portfolio to cash or safe havens like gold until the dust settles and macroeconomic conditions clarify. The second mantra is the hyped-up buy the dip strategy, which retail investors usually execute impulsively without any systemic capital allocation strategy. This leads people to catch falling knives using capital they actually need for short-term liquidity. To understand why both of these approaches fail, we have to look at the societal and historical context that shaped our brains. The average American operates on financial heuristics derived entirely from historical trauma and media conditioning. The first layer of that trauma comes from the 2008 financial crisis. For anyone who lived through it, that was a protracted, systemic collapse of the global banking system. It was not a quick dip. It was a grinding bear market that taught an entire generation to panic. It left retail investors with deep financial PTSD, conditioning them to seek hyper-defensive cover at the very first sign of market trouble. Whenever the S&P 500 drops 5%, that 2008 alarm bell rings in their heads, telling them that the entire system is about to collapse again, and that cash is the only safe place to hide. This hyper-defensive panic is a natural human reaction to a traumatic event. But applying that same defensive posture to every standard market correction is mathematically devastating to your net worth over a 30-year investing horizon. But colliding right into that 2008 trauma is the bizarre conditioning of March 2020. That was a central bank-fueled, artificial V-shaped recovery. The market crashed violently, but it rebounded almost instantly thanks to unprecedented stimulus. This taught millions of newer investors to take hyper-aggressive, uncalculated risks, assuming that the market will just bounce back in a matter of weeks. This clash of traumas creates the illusion of the macro guru. Society starts to believe that financial experts can actually predict the bottom, and financial media thrives on this prediction theater. The average investor is led to believe that successfully navigating a crash requires them to guess which trauma is playing out this time. Is it a decade-long grind or a 3-week dip? Trying to answer that question is a trap. Next, I am going to show you exactly how the math proves that stepping into this prediction game guarantees failure. Most people stop here, move to cash to feel safe, and end up losing $50,000 in future growth. Here is the exact mathematical step they miss. To understand why reacting during a crash destroys wealth, we must break down the mathematics of expected value and drawdowns. Human intuition handles linear math reasonably well, but it completely fails at geometric compounding. The trap is triggered when investors see a drawdown and attempt to time their re-entry. Let us run the actual numbers. A 10% portfolio drop requires an 11.1% gain just to break even. A 20% drop requires a 25% gain to break even. And if your portfolio drops 50%, you do not need 50% to recover. You need a 100% gain. When an investor sees their portfolio drop 30%, their amygdala screams at them to sell and wait in cash. It feels logically sound to stop the loss from getting to 50%. But the math of recovery is brutally unforgiving. The reason going to cash is a mathematical death sentence is because it requires you to make two completely independent, perfectly correct decisions. You have to know exactly when to sell to avoid the bottom, and you have to know exactly when to buy back in to catch the rebound. I have reviewed the historical data, and it is a nightmare for market timers. Historically, 78% of the stock market's best days occur either during a bear market or within the first 2 months of a new bull market. Missing just the 10 best days in the market over a 20-year period cuts your ultimate portfolio value by over 50%. Let that sink in. Statistically, your probability of successfully timing an exit and a re-entry to avoid the worst days while also capturing the best days is indistinguishable from zero. When you try to outsmart a drawdown, you are not protecting your money. You are simply ensuring that you miss the explosive days that drive all long-term returns. Let us take this a step further and look at the safe yield trap using realistic numbers for this year. Let us assume a crash hits. T-bills are currently offering around 4.5%. Inflation is sticky at 3.0%. The investor gets nervous and decides to move $100,000 into cash to wait out the storm. On paper, this looks like a smart defensive play. You are securing a nominal yield of 4.5%, which is $4,500 a year. But the math does not stop at the nominal yield. First, we have to apply the tax drag. Assuming a standard 24% marginal tax bracket, you are losing over $1,000 right off the top to the IRS. Your net nominal return instantly drops to roughly $3,400, or 3.42%. And we have not even accounted for the silent killer yet, which is inflation. Now we subtract the inflation drag. At a 3% inflation rate on that $100,000, you are losing $3,000 in purchasing power. When you subtract that from your net nominal return, your actual real return is $420. That is a 0.42% real yield. By attempting to stop the bleeding, the investor mathematically guarantees zero real growth. Meanwhile, look at the investor who remains in a broad market index during the crash. Yes, their net worth drops temporarily on paper, but their cash flow, specifically their dividend yields, often rises in percentage terms as the stock prices drop. Because they are enrolled in a dividend reinvestment plan, those dividends are automatically purchasing more shares at heavily discounted prices. They are accumulating a massive volume of cheap assets. When the recovery eventually triggers, that increased share count accelerates their compounding curve exponentially. Cash gives you the illusion of safety, but equities give you actual mathematical leverage. If you think you are too smart to fall for that math trap, wait until you realize your own brain is actively trying to bankrupt you. In a crash, you are not fighting the stock market, you are fighting millions of years of evolutionary biology. The neuroeconomic reality of a market crash is absolutely fascinating. When you experience a sudden financial loss, it processes in the exact same region of the brain as mortal physical danger. That area is called the anterior insula. Your brain literally cannot differentiate between your portfolio dropping 30% and being chased by a predator in the wild. This biological short circuit triggers a cascade of behavioral biases that override all the logical math we just discussed. Willpower becomes completely useless because you are trying to use a spreadsheet to fight a primal survival instinct. Understanding this biological disadvantage is the first step to overriding it. The most dangerous byproduct of this biological response is called action bias. In high-stress, high-cortisol situations, humans feel an overwhelming compulsion to do something. Standing still and simply holding your portfolio feels like gross negligence. Executing a trade, even a mathematically terrible trade like selling everything to cash, feels like you are exercising control over a chaotic environment. It relieves the immediate psychological pressure. You click sell, the red numbers disappear from your screen, and for about 5 minutes, you feel a massive wave of relief. But that relief comes at the cost of your financial future. You have just permanently locked in a temporary dislocation. Action bias is why so many investors tinker with their portfolios during a correction, convinced they are optimizing, when in reality, they are just soothing their anxiety by pressing buttons. Compounding this action bias is a phenomenon known as myopic loss aversion. Behavioral economists have proven time and time again that humans feel the pain of a loss 2.5 times more intensely than the joy of an equivalent gain. Now, apply that to the modern era of smartphone investing. When the market is crashing, people check their brokerage apps daily, sometimes hourly. Every single time you log in and see a sea of red, you are artificially multiplying your psychological pain. You are dosing yourself with a fresh hit of cortisol. Eventually, the cognitive load becomes so incredibly heavy that you hit a breaking point. You do not sell because the intrinsic value of your index funds has changed. You sell simply to relieve the cognitive load and stop the pain. You are treating a psychological symptom by amputating your financial leg. This vulnerability is exactly what the prediction theatre dopamine loop preys upon. Consuming catastrophic financial news releases stress hormones. Then, a pundit appears on screen, offering a complex solution, like buying an inverse ETF or rotating into a niche commodity. This gives you a dopamine hit of perceived safety. You become addicted to the narrative, entirely detached from the math. And here is the invisible risk that this media loop hides from you. The duration of capital dislocation. The hidden penalty people ignore is not the market dropping further. It is the opportunity cost of being uninvested when institutional capital rotates back in. Institutional algorithms reallocate billions of dollars in milliseconds. Retail investors, hooked on media narratives, take weeks or months to feel comfortable enough to reinvest. By the time the macroeconomic headlines look safe to the average viewer, the mathematical premium of the recovery has already been completely extracted by the algorithms. This is why we need a protocol. If you think your willpower can outlast a bear market, wait until you are forced to sell your stocks just to pay your mortgage. An optimizer does not rely on willpower during a crisis. They rely on algorithms and pre-written protocols. The plan written in a state of low cortisol logic easily overrides the ideas invented in a state of high cortisol panic. Protocol 1 is the liquidity algorithm, or the cash bucket. The absolute golden rule of investing is that you must never be forced to sell equities at a loss to fund your lifestyle. The system is straightforward. Maintain a strict cash bucket equal to your monthly burn rate multiplied by 6, plus any forecasted capital expenditures within the next 24 months. The math here is your armor. If a crash happens, you do not even look at your portfolio for living expenses. Because your short-term liquidity is perfectly secured, your temporal horizon for your equities remains infinite. Knowing this math is one thing, but actually bridging the gap to execute it is exactly why I built CashClass. CashClass is the official Tom Talks Money web app, designed to give you total clarity over your cash bucket and portfolio without the usual friction. I built it with a privacy-first angle. There are absolutely no bank logins required, You just upload your CSV statements directly to the web platform. Plus, it includes a free Budgeting 101 course to help you build that initial liquidity algorithm. You can click the link at the very top of the description to start your 14-day free trial on the web. Once your liquidity is tracked, we move to Protocol 2, which is emotionless rebalancing. You do not buy the dip based on a gut feeling. You use strict mathematical rebalancing bands. You set a target asset allocation, let us say 80% equities and 20% bonds. Then, you establish a 5% absolute deviation band. If a crash shifts your allocation to 70% equities and 30% bonds, your protocol dictates that you systematically sell bonds to buy equities until the 80-20 ratio is restored. You are mathematically forcing yourself to buy low and sell high via an algorithm. Protocol 3 is where we turn a market crash into an IRS tax credit generation event. This is systematic tax loss harvesting. When the market drops, you identify index funds in your taxable brokerage accounts that have a negative cost basis. You sell the losing asset to capture the paper loss, but you immediately buy a highly correlated but not substantially identical asset to avoid the wash sale rule. For example, if you sell an S&P 500 ETF, you immediately buy a Russell 1000 ETF. The math behind this is brilliant. You maintain your exact market exposure for the eventual rebound, but you capture a permanent paper loss. You can use this loss to offset up to $3,000 of ordinary income annually, and you can bank infinite losses to offset future capital gains. You are generating immediate, quantifiable alpha for your portfolio just by swapping funds while everyone else is paralyzed by fear. Protocol 4 is the capital deployment rule. If you are sitting on cash beyond your emergency bucket during a crash, do not try to guess where the bottom is. We defer to the math. A massive Vanguard study proved that lump sum investing beats dollar cost averaging 68% of the time. The reason is simple. Markets go up more often than they go down, and capital deployed earlier earns the risk premium for a longer period. However, here is the psychological compromise. If deploying a lump sum into a crashing market triggers paralyzing anxiety, execute a strict 3-month DCA contract. Divide your cash by 3. Deploy it on the first of the month for 3 consecutive months. Automate it completely and remove human intervention. Protocol 5 is the final lock on the system, the information blackout. Zero prediction theatre. Turn off CNBC. Unfollow all macro forecasters on social media. If an action does not fit into protocols 1 through 4, it is pure noise, and it will cost you money. We will get to the final historical averages in a minute, but first we need to fix a massive blind spot that ruins retirements. It is called sequence of returns risk. This is a critical variable for anyone who is actively drawing down their assets. A market crash early in your retirement mathematically destroys a portfolio vastly faster than the exact same crash happening 10 years later. If you are forced to take a standard withdrawal while your portfolio is down 30%, you are permanently liquidating those shares at a severely depressed price. Those specific shares can never participate in the market recovery. This is precisely why Protocol 1, the cash bucket, is mathematically non-negotiable. It completely isolates your cash flow sequence from your net worth sequence. You simply spend the cash bucket while the equities take their time to recover. Without this isolation protocol, a market crash is not just a dip, it is financial ruin. To really cement this optimizer mindset, I want you to anchor these protocols to 2 perfectly logical analogies. First, think of yourself as a pilot flying through turbulence. When a commercial airplane hits severe turbulence, the pilot does not rip off their seatbelt, open the cabin door, and jump out with a parachute just to stop the shaking. They rely on the intense engineering of the aircraft, and they fly through the storm. A market crash is simply financial turbulence. Jumping to cash is jumping out of the plane. The second analogy is the grocery store discount. If your favorite cuts of premium meat suddenly dropped in price by 30%, you would not run screaming from the supermarket in terror. You would buy a chest freezer and stock up. The stock market is literally the only asset class on earth where consumers run out of the store when a massive clearance sale is announced. Train your brain to see the discount. The third analogy is the casino versus the house. The macro forecaster trying to time the crash and the rebound is just the gambler at the roulette table. They are hoping to get incredibly lucky twice. The systematic optimizer is the casino itself. We do not care about the outcome of a single spin of the wheel. We rely entirely on the mathematical expectancy over thousands of spins. In the stock market, that mathematical edge is the equity risk premium. If you appreciate treating your wealth-building journey like casino math, hit the join button below to become one of the optimizers. Channel members get priority comment replies and custom sketch badges, and it directly supports this analytical approach. That equity risk premium is the excess return you get for investing in stocks over a risk-free rate. It only exists because of volatility. If there were no crashes, there would be no risk, and therefore no premium. You are paid handsomely to endure the drawdown. Let us look at the core historical averages to anchor your expectations. Historically, the S&P 500 experiences an average intra-year drop of 14.2%. A double-digit drop is completely normal. Yet, despite that terrifying annual drawdown, the market manages to finish the year positive roughly 75% of the time. Crashes and corrections are a feature of the market, not a bug. They are the toll you pay to access the road of geometric compounding. So write your playbook today while your cortisol is low. Fund your cash bucket, establish your mathematical rebalancing bands, and set up your tax loss harvesting pairs. When the market finally drops, you will not need courage, you will just execute. I want to know what your specific plan is. Drop into the comments and let me know if you are a lump sum investor or if you prefer a strict DCA contract during a crash. It is great peer review for everyone. Trust the math.